Hey, Jed.
Hello, 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 Caleb, sir.
You hear me all right?
I can hear you just fine.
All right. Well, I'm getting over pneumonia, so hopefully everything sounds fine on my end.
Well, you're sounding fine so far, so let's just go with that. Um,
Awesome.
so today we've had a little bit of a change in schedule. For those of you who are on the off market leads challenge, we just wrapped that up, and I recorded the whole thing. I'm definitely going to help you out with that. That'll be saved into the afternoon, so you have the opportunity to go take a look at that. For everybody else, we are doing a special moment here with Caleb, where we're going to walk through the numbers that kill deals. And so, for those of you who don't know, you know, you probably do know since we're here at Surgeon School, but I'm Jed Morris. I run Sunset Coast, independent sponsor firm looking at GovCon businesses. And I have used Caleb's personally on deals, including our very last deal. And Caleb and his team, they run QOE prep, quality of earnings prep. Caleb is a little bit unique in the sense that his firm, although he's a licensed CPA, and several of his team members are licensed CPAs, they only do quality of earnings evaluations. They don't do anything else, not tax, not accounting, not advisory, just QOE. And correct me if I'm wrong, but you guys did over 80 QOEs just this past year. Is that right?
Yeah, unfortunately, that's a little high. We did about 55 in the last 12 months.
Okay.
So,
All right. But still, a ton,
yeah.
a ton.
Thank you.
And it's even more impressive when you realize that you guys just had a new baby just a couple months ago, which is just
Yeah.
wild. So I can't imagine how busy you are over there. Um, But I wanted to have Caleb on here because one of the things that trips up searchers the most is financial diligence. And it's not just that we have to make sure the finances are correct, but there's this overwhelming fear. When I was a first time self funded searcher, I probably my biggest fear was dead deal cost. It was, oh my goodness, what if I sign an LOI with this company? I get halfway through diligence and I spend $10,000, $15,000 on legal. I spend $5,000 on consulting services. Maybe I spend 10, 15,000 on a QOV just to find out that this is not a good deal, and now I'm sunk. And granted, most searchers have some search capital, but if I do that two or three times, I'm screwed. Like I've liquidated all my capital. Now I have nothing else to go on, and so you're always super hesitant when it comes to the financial side. And a lot of times that leads you into making bad decisions that you otherwise wouldn't have made. And so one of the things that I really want to focus on with today's session with Caleb is we want to identify the three biggest things, the three biggest red flags that you as a searcher are looking for in financials before you ever engage with an actual quality of earnings evaluation. And so the way I recommend this to literally everybody I speak with is you need to have your deal team ready to go. You need to already, if you don't have a QOV, speak with Caleb. Introduce yourself, have a deal team ready. If you don't have a lawyer, definitely speak with a lawyer. Talk to people ahead of time so you actually know who you're using, because you never know when that LOI is going to come. Could be tomorrow, could be 6 months from now, but you want to be prepared. But more importantly, when that deal does come across where it piques your interest and you've asked for those initial financials and you're starting to look through it, especially for those of you who do not have a finance background, we want to be able to help identify those big red flags that are absolutely going to kill your deal so that you can spot them before wasting money allowing your QOV to spot them. Your QOV should be able to find the things that you can't find on your own. And that's why I wanted to bring Caleb here, because he's seen so many of these QOVs, and we're going to walk through the three biggest things that over and over and over kill the deal. How's that sound? How's that sound, Caleb?
It sounds good to me. And we can make this conversation know as well. If you guys have any questions, feel free to open up your mic and talk, or drop it in the chat, and Jed can ask it so that the audience can hear it. Is this one recorded,
It is.
Jed?
Yeah.
Yeah, yeah,
Yep.
just so that the audience can hear it. Whoever's watching the recording, that might be helpful. But I put in my website, QOEprep.com, and I've also uploaded basically a screenshot of what we include in our QV analysis. So any one of these analysis or tabs that we do can kill a deal. So that's why we add everything into our QV analysis. A lot of times you'll hear people saying, "Oh, can I get a QV light? It's a simple, clean deal." The broker says the numbers are really good. My response is, well, what risk are you willing not to look at in order to buy the company? And and I find that like there's always going to be someone who undercuts me in price. Um, Unlike a lawyer, you don't have to be a CPA to do a QB. That rule is probably going to change pretty soon with SBA lenders. But at this point in time, any accountant, I've been an accountant since sophomore year of college, any accountant can do a QB for now. And I'm pretty sure that's going to change pretty soon. But I'm a CPA. My coworker's a CPA. So this is how we do our work. So the first step, the big deal killer, is a book to tax analysis. So lenders, they'll go off of the tax return income, and that income can sometimes be higher or lower than a financial statement income. When a broker and a seller are presenting their numbers, they're going to show you the financial statement income on an accrual basis if they're good, but sometimes it'll just be on a cash basis. And that might be different than what the taxable income is because a lot of business owners want to lower their taxes and they call it tax strategy. The problem with that is sometimes it's fraud. The other problem with that is a lender can't finance it if the add backs from the tax returns don't hit their DSCR threshold. DSCR stands for debt service cover ratio. So if a lender can't finance the deal, that kills it. Or, if you ask someone, why did the deal die? A broker's always going to say, oh, the buyer wasn't qualified, or it's always the buyer's fault why it didn't go through. But if you ask a buyer, they'll say, oh, the business owner was overreporting their earnings. That's the answer you get in 90% of it, of the responses. Another big deal killer is um, customer concentration risk. So one
Hold on just a
company,
second, Caleb.
oh, go
Before you
ahead.
move on to
Yes.
customer concentration, like here's a real world example of like what those finances look like, right? So the vast majority of small businesses, they love to run their expenses through their business and they're encouraged to do that for tax advantages. And so what you'll see all the time with a broker is they'll have these ad backs where they're like, hey, the business owner was running like his personal truck and his boat and his last vacation because that was a quote unquote business expense, like all through the business. And those expenses they won't apply to you, and so we're going to add those back. But then at the same time, you'll look at the tax statement and you'll see that, oh, well, on tax purposes, we only made $100,000 last year, but on SDE, it was really 600,000 because we ran all of our expenses through. And that's where you run into trouble because
Yeah.
these numbers are not going to match up all the time. But if they're that far off, then you have to look at it, like you said, from a lender's perspective. Like, is that really cash flow? Can I actually lend on that? Probably not.
Yeah. And then I want to add as well, good thing, and I brought this up. Every lender's different. Some lenders are known as closers. They're going to get the deal across the line. They're going to figure out some type of structure that works, but their
Yeah.
interest rates are going to be higher. And some lenders are known as very conservative. They're only going to lend on this deal if it's really, really good. And brokers, a lot of business brokers, a lot of times, and I guess they're allowed to do this. There isn't a rule saying they're not, but they make money from selling the business, and then they can
Yeah.
also make marketing fees, I guess you call it, from introducing the buyer to a lender.
Yeah.
Is that a
Yeah.
conflict of interest? I think it is. But there hasn't been an established SBA rule about that. So essentially, what they're doing is they're picking the most risk-friendly lender, the one that's most likely to get it done. And they're saying, hey, here's a pre-approved loan. Here's a pre-approved business by a lender. As long as the buyer's okay, we're just gonna get closed. And what that happens a lot of times is they'll say this to me all the time. They're like, "But Caleb, the lender already approved it. The
Mhm.
broker has all the numbers right. Why are you slowing up the deal?" I'm like, "Hey, I'm just asking questions. You just have to give me good responses as to why you're adding certain things back, and basically show me the numbers."
Yeah.
So that's why I think it's important to get a lender that's outside of the seller's preferred lenders,
Yeah.
because it makes it more likely to where the deal is going to be a little bit more impartial.
Yeah, and I'm glad you brought that up because one of the things I hammer all the time is the incentives in the industry. As the buyer,
Yes.
you need to understand everyone's incentive. You don't realize a lot of times, yes, obviously the broker is making money on the commission, but a lot of times, if they're referring you a lender, they're making money on that commission too. I've seen brokers who say, I only will do this if you work with this type of lender. And as the
Yeah.
buyer, you need to walk away immediately Like if you're the buyer and you're the one showing up and you're willing to sign a personal guarantee or more for millions of dollars, then the only one who gets to dictate the terms of the deal is you, right? And sure, the seller can decide not to sell, but if I'm the one who's going to personally guarantee a few million dollars, then
Yeah.
it's going to be on my terms. I'm not using your LOI. I'm not using your lender. I'm not using your QofE or your lawyer for that matter. I'm doing everything the way that makes the most sense for me and my search from a risk perspective.
Yeah, good point. And speaking of LOI and lenders, a big trend that's changing is brokers are now trying to skip the exclusive LOI and have serious buyers only sign a purchase agreement and then have a condensed due diligence phase. But there's someone else competing, and you have a non-refundable down payment.
It's insane.
I, I have done 3 deals like that. None of those deals closed.
Yeah.
I don't know if there's a high correlation between that, but I feel like if a broker and a business owner are presenting their numbers well, and I do a lot of sell side deals as well, hence the name QOE Prep. If they present their numbers well and show the true profitability of the business, you don't have to do that. So
Yeah.
I view that as a red flag. A lot of people may have different opinions, but any of your buy side lawyers will be like, no, no, don't do that at all. Because then what happens if like the QV finds out that earnings is 30% less than what the sellers are representing earnings as? Do you get that deposit back? In a lot of cases, no. So
Yeah.
I hate the sign a purchase agreement, condensed due diligence timing. We want serious buyers only.
Yeah.
I
That
don't.
also
I
speaks
don't.
to the professionalism of the industry. Like, we all kind of know this, but in the lower middle market, especially in the SBA world, there is no credential required to be a broker. Some states require a real estate license. Beyond that, there's nothing. Anyone can just raise their hand and decide, I'm a business broker. And as a result, they're all trying to do the same thing, which is close. And so if that
Yeah.
means like, trying to convince you to sign a purchase agreement before you even look at the financials, that's insane. That's exactly why it's so important for you as the buyer, again, to take full ownership of your search. You need to surround yourself with a deal team who is smarter than you, but at the same time, you can't give up any of that ownership. You have to sit down with your lawyer and fully understand exactly what's happening, your QOV, everybody, because ultimately the only one signing the purchase agreement is you, and the only one on the hook if things go south is you. And it's
Hmm.
actually a really great testing ground for you to be able to step into a business and actually be an owner because you need to take responsibility for the entire process.
Yeah. Yeah. And then this brings us to the next red flag, which is customer concentration. Essentially, if a customer represents more than 10 or 20%, most lenders care about 20%. I don't care if it's just 10% of revenue. That needs to be pointed out. And lenders want to see some kind of seller's note to lower their risk. If because the idea is these small businesses under 5 million in revenue, they they're very relational. So if the business sells as an asset purchase, there's no agreement between the new business owned by you, the new owner, and those customers. There's no signed agreement. So that they could just leave and then the whole everything, nothing works there. So that's another red flag.
Yeah. And before we continue, those of you guys on the call, feel free, like Caleb said, you can unmute, you can ask questions. If you want to drop a question in the chat, that's totally fine too. I like to talk, so I love to interject all the time. Um,
Yeah.
but this
It
is
helps me
also
because I like to listen.
this is also industry specific. And so I found a company last fall that was doing 6 million in total revenue, and 70% of that revenue came from one customer. Normally, that would be a massive red flag. However, it was aerospace, and that customer was Boeing. They had been a customer for 30 years, and they were a tier two supplier, right? Aerospace, these types of industries, they're gonna have massive customer concentration, and so that's a risk. That there is. We always talk about how there's no such thing as a perfect business. Well, every industry has its own little quirks. At Sunset Coast, we look at GovCon, and the vast majority of GovCon, you could, depending on how you decide to parse the customer, you could say that because 100% of our revenue comes from the federal government, we're very concentrated. Or you could dive a level deeper and say, well, 20% comes from the Air Force, 40% comes from Department of State, 5% comes from Department of Interior. So you can kind of parse it out a little bit. But knowing your industry and knowing the nuance of your customer is really important. And Beyond that, though, one of the things I've seen is that sometimes there is customer concentration that isn't obvious. And you have
Hmm.
something where an owner, maybe their number two customer happens to be like their son or like a cousin or a crosstown friend. And what you'll find is that, that particular customer, because they have that type of relationship with the owner, that customer only exists because the owner is there. And the moment the owner leaves, they may not compete with you directly. They'll just open a different business doing something in a different industry and just take your customer anyway.
Yeah, exactly. And similar to sales concentration, or like that's the salesman concentration. If the salesman making all the sales, that's a big risk. The lead generator concentration, where are these leads coming from? I say I get 70% of my leads from people who know me. So if I try, if the lead's that close, if I try to sell my business, man, take this off the recording. Not kidding. But if I try to sell my business, I know that the new buyer will not get as many leads as I do because some of the leads come straight to my cell phone. And the business is really Caleb Basile. We do have three people on the team, but at the end of the day, I'm the business. So
Yeah.
I say that not to devalue my company, but just to be transparent and be like, if the business owner gets all the leads, that presents a risk to the buyer. And that could also be an opportunity. Maybe that business owner is bad at sales, and you can have a higher conversion rate than that business owner. If you're an accountant like me, you probably won't have a higher conversion rate. It took me a while to learn. It
Yep.
took me 4 months and 250 calls before I started closing deals, and then I closed
Yeah.
seven in 1 month. And
Yeah.
now, like, even though my prices are going up, I'm still closing 30 to 40% on buy side deals and 60 to 70% on sell side deals. And that's with my prices increasing and with there being more competitors. So like
Yeah.
you get used to learning how to sell.
Well,
Um,
you know what they say, you get what you pay for. And the
yeah,
more your reputation grows, then the more people see that, especially in an industry like yours, it's reliability. Like you get exactly what you pay for. If I'm going to have somebody take a look at the finances of a company and try to give me confidence or disqualify that company, then I'm putting a lot of faith in you, just like I put a lot of faith in my lawyer, that you guys are excellent at what you're doing. And that is the risk level of going with somebody who's unqualified or not as good is infinitely more than a couple $1,000s on a price margin. Um,
mhm.
One other thing this brings up, though, is customer concentration. We were talking a lot about sales. Um, it also helps you dive into, well, who's actually the rainmaker in this company? For
Yeah,
most small businesses that the vast majority of you are going to look at, the owner is the rainmaker. The owner is the one who's out there making the sales. They have no business development to speak of. Sometimes there's a couple salespeople, and there's somebody I interviewed probably 8 or 9 months ago who bought a company and everything looked amazing. Like they did the QofE, they had legal take a look at it. Everything was great. The owner was wonderful, really nice guy, really friendly. They had two dedicated salespeople. Each one of those salespeople bringing in 50% of the total revenue. So everything seemed really nice, right? And the buyer was very smart about it. They thought, obviously the owner's been separated from the business, runs the back end, but hasn't been involved in sales in a while. It's just these two salespeople. And so, as a pretext for the close, he wanted a chance to sit down with both these salespeople, which was totally real. That made a lot of sense. And he was able to do that. And he talked to both salespeople, got the warm fuzzies from both of them. Everything seemed fine. Even got a little bit of a seller's note that was conditional for the first 12 months of both those salespeople being able to be retained by the business. So anything you can think of, did it by the book, only to find out about a month after buying the business that one of those salespeople was toxic. In the buyer's words, he was the devil incarnate. That's what he told me. And it turned out that this guy apparently was, had that charm, was really friendly with all of the clients, but was just a absolute horror show inside the business. And it turned out that the owner, while being very nice, had basically was non-confrontational, had basically sidelined himself from his own business and let this guy kind of run roughshod. And ultimately, that ended up being a very bad situation because, as you can imagine, that person left a little while later, took half the business. So it's really important to know, like, not just who the owner is and who the customers are, but who's the rainmaker in this company, who's bringing in the sales, and what's that risk profile look like?
yeah, yeah. Thanks, Jed. Another big red flag, and this makes lenders pause all the time, even like if they just barely start looking at the deal. So if you're about to sell, if you're going to sell a company in 2025 or like in first quarter of 2026, you might try to show as much revenue as possible in 2025. So your taxes mysteriously go up. Um, but what a lender does is they say, let's see the year-to-date comparison. So let's see January to May of this year compared to January to May of last year. So that it's called a year-to-date comparison. And if it goes down by a certain percentage, I don't know what it is. Um, More than 20%, it really slows everything down. But if it goes down by even more than 10%, like it it lenders are less likely to lend on that business. Another thing similar to that is profit margins. Um, so profit margins are essentially sales minus cost of goods sold is your profit, or EBITDA margins as well. They're very similar, but that includes operating expenses. If those margins are starting to go up in 2025 or like the last year, you need to see if that's sustainable or not. Because a lot of brokers will teach their sellers, hey, stop making any discretionary expense, only make the necessary expenses. That way we can sell for more because you're showing a company that's more profitable year to year. So if like revenue's staying the same, but income is going up or EBITDA is going up and margins are going up, there might be some expenses that are delayed, like marketing. That's a big one. People stop spending marketing because they know that it's like a 3 month sales cycle. So marketing expenses go down, and then when the new buyer buys a business, there's less leads, and they haven't burdened the P&L for what a normal level of marketing should have been.
Yeah, that's one of the things I see all the time. When the owner decides to sell the business, then all of the discretionary expenses of the business just start drying
Yeah.
up. And that
Or
can be
or
a big
suddenly
problem.
suddenly there's employees that they no longer needed or who did nothing
Yeah.
and like
Yeah.
they fire them right before selling for the full year to sell for a little bit more and they got leaner and more efficient.
Yeah. But in reality, all they did was just slow down.
Right,
Yeah.
yeah, or yeah, that's true.
Yeah. It's important to pay attention with that, especially when it comes to things like marketing is a clear one. A lot of small business aren't even doing marketing to begin with. And so one of the areas I see it a lot is with maintenance, deferred maintenance. A lot of companies, especially if you're looking in blue collar, blue collar services businesses like HVAC, landscaping, plumbing, for whatever reason, the 12 months before they want to sell, none of their trucks broke. None of their stuff, got replaced. Their older vehicles weren't replaced. Their older equipment wasn't replaced. And what that means for you as the buyer, obviously, is that you're inheriting older things that will need to be replaced. That all that deferred maintenance actually costs money, and that's money uh, that's going to be a direct cost to the business the moment you take over. And so you need to be really clear about that, as well as making sure that there's a reason why there's a paragraph in the LOI that says the seller will maintain the current operations of the business at the current pace. Like you're not going to slow down. You're not going to
Yeah.
cut expenses. You're not going to, defer sales or try to hurry sales to try to get more revenue in before you close. Things need to stay the same. One final thing, like you touched on the very beginning, that I think is really important is that I can't tell you how many times I've had a one-on-one with a buyer who said, "Hey, Jed, I found this great business. Historically profitable for the last 20, 30 years. They've been slumping the last 2 years, and revenue's
Yeah.
gone down like 30%. But I think it's a really great opportunity to buy because now I can get it even cheaper." My friends, you are not in distressed asset acquisition. Like just buying a business, especially for the first time, is incredibly risky and it's going to take a lot out of you as the owner. The last thing you want to do is put on the additional weight of buying a business that's in decline. Like just trust me on this, stay away. Take Warren Buffett's advice and buy a great business at a good price. Stop trying to buy something super cheap. Find a good business, pay a fair price for it, and try not to cut pennies on that. I'm not saying spend 6 times. I'm saying spend 4.5 to 5 on a really good business.
A good point. Um, yeah, I guess I'll open it up to questions. Oh, but I did drop my newsletter, which kind of talks about a variance analysis, and we can catch
Yes.
a lot of those things where there should be expenses layered into the P&L, but they changed it in the very last year. So like marketing as a common size basically means we look at things as a percentage of total sales. So it's like 3%, 4%, 5%, rather than a dollar amount.
Yeah.
Yeah, thanks for the presentation, Caleb. I'm in Toronto, Canada, so I'm not asking for my own interest because I'll probably use a local provider. Just curious what the cost range for your mandates typically is, because I just want
It,
to compare north of the border.
yeah, we charge more than Toronto. For deals between 1 million and 5 million in revenue, it's generally going to be 12K to 20K. But you get two CPAs on each deal, which is a little bit cheaper than a regional CPA firm. There are non-CPAs that do this as well, and so they'll charge less. And then there's also Big Four that does this, and they'll charge 80 to 100K for this. So it really just depends what you want.
I actually think that's fairly comparable. I mean, I'm talking in Canadian dollars now, but I think if you use like a family friend here, you can get it
Yeah.
closer to 10K or maybe under. And I've
Hmm.
heard numbers as high as 40, but
Yep.
that's probably for like a company doing north of like 20 million in revenue and fairly
Yep. Yep.
comprehensive engagement. But no, okay, that actually seems pretty
Yeah.
similar in both
I've
cases.
done I've done a few deals in Canada. So
Oh, yeah,
it
okay.
yeah,
What?
we're not lawyers. We can practice in other states and countries. But if you're getting a lawyer, like for legal due diligence, you
Yeah.
probably couldn't use them unless they're based out of New York and have the Canadian,
Have you done Canadian
whatever.
deals because it's a US buyer or just a
I
network
did a
connection?
Canadian seller using a USA investment banker.
Okay, gotcha.
Hmm.
Yeah.
Cool. Okay, thanks.
But yep, great question. I didn't add my disclaimer, but I could just say, like, this is all education and information. None of
Yeah.
this is advice. Consult your own, guys.
Yep. One thing I'll add on there is I, obviously I'm like in the trenches when it comes to first time buyer and almost always the Q&A that comes up is this deal worth it for a QofE? And I think it's up to the buyer to decide like what level of QofE makes the most sense to them. That's a risk decision that you have to make for yourself. But what I will say is that being on the first time side and then also working with strategic buyers and as an independent sponsor, first time buyers always question whether or not a QofE is worth it. Repeat buyers never do. There is not a single repeat buyer or strategic or independent sponsor who's ever closed a deal who skips the QofE on the second deal ever. And even on the smaller businesses, sometimes people say like, "Oh, this one's only $1 million, so I'll skip QofE. It's probably not worth it. SDE is only 100 grand or 200 grand." But if I'm gonna like, what is that in comparison to a $15,000 QofE on a small deal? It's it's pennies. It's a small percentage. It's a tiny bit to make sure that you don't end up in a personally guaranteed risk. And so, just want to throw that out there. I would never recommend ever skipping the QofE whatsoever.
Yeah. And my fees are generally 0.5% of the purchase price. Lawyers are around 1% of the purchase price. Um, both of our fees can get reimbursed by an SBA lender as part of the transaction fees.
Yep. All right, we are still open for questions. If you got a question, throw it in the chat or just unmute and ask it. Otherwise, I'll keep asking questions.
Well, I mean, I could ask them like what their background is, what they're looking to buy, or like what industries they like. And we could talk more specific, whatever works.
I know that there's at least a handful of people on the call who are looking at this from the independent sponsor perspective, not from a
Okay.
self-funded search perspective.
Yep. Yeah.
And as you know, if you're outside of the United States, you by default are an independent sponsor because there is no SBA 7A loan for you.
Yep.
So, how does the QofE change for independent sponsors?
The QB's the same for me. At the end of the day, we're analyzing a deal, whether it's large or small, and we just show how repeatable the profits are. What might change a little bit is the size of the business. If you are an independent sponsor, you're buying a bigger business. So ideally, the adjusted EBITDA and what the sellers are representing and their SIM is closer as a percentage to the adjusted EBITDA on a buy side QB, but that's not always the case. But sometimes it is. On the smaller deals, things can go crazy. There's much more. Salesman concentration, much more like owner. There's much more risk on the smaller side, given that those businesses are typically smaller. Yeah, so independent sponsor helps with that a little bit. I guess I could kind of talk some facts or some interesting things. So we did 55 deals last year. Of those 55, 10 were sell side, 45 were buy side. Of those 10, every single one has sold except for one's pending. Um, of those 45 buy side, maybe 25 walked away altogether. 10 negotiated a better price and 15 bought it at that price. Um, so it's pretty interesting that like you're not like just because you're under OI, it doesn't mean that you're going to buy that company.
Yeah.
Do you have a personal preference for accounting systems and
I
ones that you
mean,
just hate to touch?
I've used every single software before because I've personally done 300 deals. I like QuickBooks. That's easy. QuickBooks Online, they just give me access. I pull the reports. QuickBooks Desktop is easy too. Sage or Peachtree are pretty easy. There's this one called Odoo that's a little bit more challenging. And then some of the healthcare systems are a little bit different.
And have you
What
been
about
able
some
to
of the?
use it? Oh, go ahead.
Go ahead.
Please. I've asked enough.
I just realized that's a question I've never asked. Like, what about more of the enterprise options like Deltek? Have you seen those as well?
Not too often. But yeah, I've done some of those, like NetSuite, some of those. But when it's those, they're always going to say, "Oh, we're not going to give you access to everything because there's too much sensitive data," and so they just give me the uh, exports to CSV or Excel. So I don't touch them typically.
The
Yeah,
question. This is
I.
Daniel.
So, oh, go ahead, Daniel.
Oh, my question is just that in the cases where you do see a sell side, firm providing the QofE, do you recommend like doing a QV of their QV or having like a QV review, or do you kind of, say, oh, it's from a known QV provider, so then that we can trust it? I just kind of curious what your approach is because I have seen deals where there's a
Yeah.
sell side QV already provided.
Yeah, that's a good question. Good observation. So I do both sell side and buy side QV, and every QV provider kind of has like a different philosophy. Some when they do a sell side QV, they're just trying to make the company sell for as much as possible, and their scope is limited to showing the company in positive light. On the buy side, it could be a different scope to be like, hey, let's just make sure we're not missing out on any expenses and let's kind of like adjust the EBITDA. So you have a QV provider that's very confirmatory and it's going to show the company being very profitable. You have a QV provider that's the opposite, kind of a chop shop. Private equity will hire these types of QV shops often to just buy the company at like a much cheaper price or different terms. And then we're QV specialists, so every ad back we do is very reasonable and supportable. And then our sell side QV is going to look pretty similar to a buy side QV. The scope might be a little bit different, what they paid us to do. But at the end of the day, we want our sell side QV's adjusted EBITDA to match with what a buy side QV adjusted EBITDA will do. And then we want our buy side adjusted EBITDA to basically show what the repeatable profits are had the new business owner owned that company the entire time. That's our philosophy, and I think that's why we get used quite often. Um, but at the end of the day, a quality of earning report is an analyst, and they're paid by their clients. So the sell side QV might be more optimistic than a buy side QV done by that same firm for the same client. Um, a valuation specialist or a 409A valuation is an independent professional's opinion of what that company is worth. A quality of earnings report is we're just an analyst at the end of the day. We're just putting together what they want us to do. Um, but it's also reputational. This business is very reputational, so we want our work to be super good, and that's why our buy side QVs and sell side QVs are pretty similar at the end of the day. Because for the sellers, we want them to be more likely to close, and for the buyers, we want them to understand how repeatable the profit is. But great question, Daniel. I've never been asked that. Yeah, and I do want to add that there are AICPA guidelines, so like how the CPAs are governed by like certain set of procedures for evaluation, but there aren't any set of procedures for QV. What we have on our website is what we believe is the most thorough and simple view of what is needed for the QV because we want our QV to be super simple for you to understand, but yet very thorough enough to catch things for you.
It's funny. This actually reminds me, this is a great question, Daniel, because this reminds me when I went to do my MBA. And at NYU, there's a professor, Oswald Damodaran, and I didn't take his class, but I audited it. And he had this comment that he would talk about how, financials are just as much an art as they are a science. And from a non-finance background, I thought for sure it's all numbers, it's accounting. It can only mean one thing, right? The numbers have to add up somewhere. And then when you actually dive into the accounting side, you'll realize that like you can make those numbers say anything you want them to say. And so just like anything else, like bias absolutely creeps into any report, any analysis. It's exactly why one person can think Tesla's worth $1,000 a share and someone else can say it's worth 20. And so you have to be careful about who's actually putting together the report. And I can tell you as a buyer, I'm only going to lean on stuff that has a um, has a obligation to help me. Like I want a Q of E that has my best interest. I want a lawyer that's got my best interests. I want people working for me. I'm just not going to take the work of somebody else. I'll take it into consideration, just like a sim, but I'm definitely not going to lean on it, especially if I'm the one signing the risk.
hmm And that brings up to like a mutual lawyer or what they call a non-biased lawyer that a broker has found for you to sign and agree to terms
Yeah.
together that represents both sides. A broker won't use that lawyer unless it's helping his clients. So I
Yeah.
don't think there's a such thing as a neutral lawyer. This is why I got into QOVs because it's kind of confrontational and there's an aspect of winning. Like I couldn't do a really good tax return and be like, "Hey, client, you owe this much to the government." That feeling was terrible. But for this, I can really help you buy the company at the right price, or it can help you when you do sell your company like at the right price at the first time. Like that's the outcome they get. And it just feels so much better. So like we actually don't do we don't work with private equity clients because one, they're not fun to work with, at least my experience was. But two, I'd rather help that business owner sell their company than help a private equity tear the business apart and buy at a way cheaper price. So that's kind of our policy. Like everyone talks about how PE is such great clients, and I might be losing some clients by saying this, but from my experience, they're not the best clients. And it's because like we want to get good outcomes and like provide a ton of value. And for PE, like yeah, we've got amazing outcomes for our clients, but I feel bad for the business owner. Like I like literally feel morally obligated to help business owners sell their business to individuals rather than private equity because I just don't like that feeling. But if you're a business owner, you might sell your company for a ton to PE. So that helps out. There's always
Yeah.
positives and negatives to everything. And I know not every private equity client is bad.
It's funny. I always feel like kind of bias as well because obviously I speak with a lot of buyers, and buyers are always trying to find the best deal they possibly can, not necessarily trying to undercut a seller, but they are trying to find a good deal at a fair price. And what I see all the time is when I talk to buyers, I'm like, yes, go find a good deal, make sure you're negotiating properly, but I always make sure to tell sellers like who are not involved. I don't compete people, but I tell sellers, I'm like, guys, if you're thinking you can sell your company without really good representation, you are going to be taken to the woodshed every single time. Like
Yeah.
get a good broker, get a good representation. Selling your company off market proprietary is not in your best interest. The buyer has all the cards. So yeah,
Yeah.
same kind of
And
situation.
the best outcome for a business seller isn't to sell to like an individual buyer. It really isn't all the time. Sometimes they need to sell to a strategic business that already runs a lot of it has the operating expenses, so they'd be able to remove some of the expenses, and then that seller could sell for a little bit more. And that's just the way this is sometimes. And a big challenge for buyers is that private equity is now competing on the smaller businesses, so it drives up multiples. There's still good deals out there. You just have to look more.
Yeah.
It's not, it's hard. It's a really, it's challenging.
Man, good questions, Daniel, Christian. These are great. Any other questions while we got Caleb here?
Apologies if this was covered at any point. I'm simultaneously Jed trying to run things in anti-gravity and finish my homework.
Love it.
Um, have you been using AI to automate any of your work just on the topic of the course that
Yeah.
Jed's taking us through?
I don't use AI because it hasn't been great for financials, but also my like engagement letter basically says I'm not going to use it, and that gives sellers comfort that like their information will be out there.
Right.
And there are CPAs that use AI and leverage AI. Does it break confidentiality? I don't know. I'm not a lawyer. So for those reasons, I'm out. Was it
Okay.
Shark Tank?
Okay.
For those
Yeah.
reasons, I don't use AI for that, just because there's so much sensitive data.
Yep.
Um, However, like I'll use it to write my newsletter. I'll use it for I don't know, kind of like thinking about margins and I won't throw in a seller's data into it, but I'll like kind of like get better understanding of it. But at
Mhm.
the end of the day, if someone's leveraging AI too much, they're not in the details and they don't understand it. So the value of using me over any other QA provider is one, I'm a CPA. Two, I'm in the weeds and I know the details of it and the nuances of different industries. And three, like you get the better outcome. So I did a sell side for an injury law firm. Injury law firms don't even sell, but now they're starting to sell. Um, and the business owner was trying to get 25 million. He ended up getting 31 million with favorable net working capital terms. So it was like 33 million, 8 million more than expected. And the buyers, they used a great company, top 10 CPA firm. I didn't, I don't want to say I corrected their QB, their buy side analysis, but I brought up points to make basically some of their ad backs invalid and help defend the price of my client.
Yeah, really good questions. Especially right now with like Claude in Excel. Like there's so many AI tools we use now to help expedite things. I can tell you from a buyer's perspective, being able to like once you have to like Caleb said, you gotta get the reps in, you gotta know what you're looking at. If you throw a bunch of financial statements into Claude and say, hey Claude, tell me about these, and you don't know how to read them yourself, then you're gonna get in this bias where you're just hoping Claude gives you the right answer. Just like you see with vibe coders who don't know how to code, but they're like, hey, build me a SaaS app. It'll get you like a little ways there, but the problems will usually come back to kill it. Um, that being said, I don't think it's quite there. Yeah, I would use it to try to identify things I don't see on my own, but it certainly isn't a replacement for your own expertise. Not yet, at
I
least.
Yeah, I've been told that if you know how to prompt things properly, you don't need to be using it to get the right response. Like you already know how to get the right response.
Yeah.
Um, but I mean, I guess it's better than nothing.
Well, where it came in useful, like I just got the Claude Pro subscription, but
Yeah,
for translating financials that live in an image in a PDF that is the
yeah,
sim and just translate it to Excel, that's really
nice.
helpful. Again, whether that's
Yeah.
a breach, I should check.
I don't
But
know. I mean, that's between
okay.
you and the seller, not me.
Yeah.
I
I
can
don't
tell
know,
you
and
that's
it's a
always been one of
gray
the
area.
hardest things. It's like
Yeah.
how to get the numbers out of Excel, out of PDF to Excel. It's always been one of
What
the most
what
difficult
what
ones.
system did they use? Do you know?
No, I'm not sure. I just let it
Because
do
I
its
always
thing.
just say just export to Excel, export to Excel. Was it like the P&L or was it
Oh, sorry,
a
I see.
different thing?
Yeah, it was the P&L, but I was working on it after hours and
Yeah,
didn't want to
yeah,
bug the broker.
they should have been
It
able to
should be a
tell.
standard to just get the Excel
Yeah,
workbook, but I haven't gotten an Excel workbook from anyone.
yeah.
Sometimes I get a scan of a piece of paper.
What are you buying
Just
in the construction industry? What industry?
yeah. That one. That one was, yeah, construction adjacent.
Makes sense. That is par for the course.
Yeah.
Doesn't those businesses have tons of money in them, but they love their PDF reports.
Yeah.
Um, Jed, this is another red flag. It's controversial, but I just want to share what I've seen. Okay. You sign the LOI, you send the request list, and the business broker says, my owner is on vacation, and they send you stuff in PDFs or they don't send you anything at all. If all that lines up, they're probably not going to sell you. or
Yeah.
something or something's going to happen because in the past, and I'm going to explain my theory as to why it happens. Basically they're delaying getting you information because the business owner is out on vacation or because they don't want to give you what you're asking for in detail. In the past, CPAs used to be paid by the hour, so the more billable time, the more that they charge a client. So they would delay, and then you'd schedule out a few weeks for the work. So they would delay giving it to the CPA, and then the CPA couldn't do the QOE as thorough as before. So yeah, that's one of my weird red flags that it really has been a pattern for my buyers. A lot of times they just don't end up buying the business if the seller goes on vacation. Because here's the thing:
Yeah.
if I own a business, I'm representing I do own the business, but if I'm selling my businesses, I'm representing the numbers fairly. I'm giving them the data right away because I know
Mhm.
that they're right. And I'm not going on vacation. Like this is the most important transaction of your life, selling your business. Why would you ever go on vacation? Unless that broker has gotten better outcomes for their clients
Yeah.
by not having the business owner involved.
Yep.
So I just haven't seen good results from it.
It's funny you say that because I don't have enough I don't have any data to support this whatsoever, but I can tell you just anecdotally the deals I've worked on and I've worked with buyers on where where that happened where like the seller was on vacation or whatever. I've heard like the broker has said straight up like, hey, this is just proof that the business can operate without the
Oh yeah, yeah,
seller.
yeah, yeah.
Yeah,
That's what
that's
it
what
is.
they'll
It's a
say.
flex.
Yeah, it's a flex. But in reality, none of those deals ever close. Like for every they drag their feet for weeks on end until finally either the buyer quits or something happens. They're like, yeah, this isn't going to work. But the
Yeah.
opposite of that is like one of the best deals I've ever worked on. The owner and their company, they had the whole data room ready to go. Like the moment we signed the LOI, we had all the financials, all the contracts, everything just immediately because they were ready. They were ready to go. And granted, most small businesses are not prepared and not ready to
Hmm.
go, but the energy level of the owner to work with you, especially early on, like obviously
Hmm.
things drag over a couple months and it sucks, but especially on day one, like they're usually tripping over themselves to try to help you get stuff, right? Because this is the biggest transaction of their lives, and they want to see this done correctly. So yeah, it's funny. I've seen kind of the same thing too, where it's like if they drag their feet early, it's just a bad omen. And if they're ready to
Yeah.
go, it may take them a little while to get their financials together, but they're sending you what they can. Here's a photo of like last week's P&L. Don't worry, I'll get you the Excel tomorrow. Then they actually get it to you without delay. So that kind of stuff, it's a good sign.
Yeah. And it's literally just a button you have to click to print to export to PDF or export to Excel. And I always
Yep.
say, make it Excel, and they still make it PDFs.
Yep. And to your point about construction, yeah, I've worked with construction companies where they're very cash rich, but they're running everything through a single checking account, no accounting system at all, right? Millions of dollars of revenue. And, but even then, the moment, like the good ones, the moment you sign an NDA, they're like, hey, here's what my checking account looks like. They'll screen share. I've had someone add me as an authorized user. Like it's pretty wild. So it's like, you can tell pretty early on, like how engaged the seller is, and that gives you an indication of like what does their integrity look like, how much can I trust them, how interested are they in a sell, because at the end of the day, if you're going to put invest into this deal like through a QOE or through legal, you want some level of confidence to close. You don't want to get all the way to the finish line and then the seller backs out and now there's nothing you can do and you're 30 grand in the hole.
I do have one more thing to add about the AI. I finished a QV, sent it over to the seller, and then the seller's like, "Yeah, me and the investment banker are talking, and we think that we can add back marketing and bonuses." I'm like, "No, you can't. There's not a chance that that's going to be accepted by a buyer." And like, "No, we ran it through AI, and it says add back marketing and bonuses." I'm like, hey, I'll add it back, but you have to give me a good memo, like give me a reason why. And their reason for marketing was like they have a new location. The reason for bonuses was they've never paid their people that much in the past. Um, I said, I don't agree with this, but let's go. Let's see what happens. At the end of the day, I'm an analyst and I'm helping them. But the client said, do it. I'm like, okay, go ahead. The buyer's QB team came in, and the two things they cut out right away were those Adamax marketing and bonus. So AI, it can definitely help you, but at the end of the day, like I mean, there's something. Everyone here is a pro at something. Eli, Christian, Jed, Daniel. I'm not sure if there's anyone else on. Christopher. Everyone here is a pro at something. If you talk with AI, you can tell that you're better than it at some things, not everything, but definitely some things. But in your specific niche, your specific industry, it's not going to give you the right responses unless you prompt it well. And if you can already prompt it well, you know what to do without it. So, yeah, that's one of the things I've seen.
All right. Well, as we're wrapping up today, Caleb, how can people get in touch with you if they want to, book a meeting with you, learn more about your firm or QOVs in general, if they have questions about financial diligence?
Thanks. Yeah, you can go to my website, QOEprep.com. You can email me, Caleb at QOEprep.com. And then I also dropped my Substack in the chat to kind of like see. I mean, it comes out once every 1 week or every 2 weeks. Basically, just stuff we're seeing in the M&A world. But
Awesome.
thanks, Jed, so much for having me on. I appreciate it.
Absolutely. Thanks for being here, Caleb. I know for a lot of people, myself included, when I was a first-time searcher, the financials are the most opaque and also is just scariest part of diligence for the
Yeah,
vast majority of people. And so, like most things, the more we can add some clarity and really get a better understanding of what's happening, the better we're going to be as buyers. Because
yeah,
for most of us, there's going to be a multi-million-dollar personal guarantee on the line. So we want to make sure we do this right the first time. So thanks for
yeah,
being here.
yeah. No one cares about high school math until they're buying a business.
Yeah. All right. Thanks, Caleb. Thanks everybody for being here.
Uh,
This recording will be posted to the group, and feel free to reach out to Caleb for other questions.
Thanks. See ya.